The hidden economics behind parking lots. Interesting. What's going on, deal makers? Welcome back to the channel. And if this is your first time here, welcome. My name is Sir Derek. I'm a financier and deal maker. Honestly, it's just a fancy way of saying that I raise and provide capital to companies and I negotiate mergers and acquisitions. Now, on today's video, we're going to be looking at the a video by Tyler. Don't know how to say his name, but you can definitely see. You can definitely see his name down there. But anyway, so he made a video titled "The Hidden Economics Behind Parking Lots." Now, for me, I have a little bit of experience in parking lots because I financed a couple. But then before that, I've actually had some friends who actually had valet businesses that end up turning it into a parking lot, where they end up buying parking lots and everything. The economics behind them are pretty interesting from my perspective, from my experience, as well as they make a lot of money. So I'm very interested in seeing what he's talking about when it comes down to the hidden economics behind parking lots. But anyway, with all that being said, listen, please remember to like, subscribe to the channel. It really helps us out. And with all that being said, hey, let's jump into the video.
36,000 parking meters for $1.15 billion.
NBC5 Investigates wanted to know just
1,000. In 2008, Chicago sold the rights to 36,000 parking meters for $1.15 billion.
NBC5 Investigates wanted to know just how much has the city lost out on this deal.
The city gave up more than 7 decades of revenue.
At the time, city officials celebrated the windfall. They sold it.
7. Whoa. Okay. Because I was going to say the same thing. Like, why would they give that up? Why would they give it up? Now, if they were only if they sold it for, if 1 point whatever billion dollars equals 70 years of revenue, then yeah, I would have sold that too. But I'm sure, as we know, living here in America, that's probably not true. They probably sold the rights for it for literally pennies on a dollar,
to address the deficit in their budget and avoid the need to raise property taxes. But they're not celebrating anymore. By 2025, those investors had collected every dollar back, plus $500 million in profit, with 60 years still left to collect. Chicago got...
Oh, Jesus Christ. See, exactly. Oh, my God. One thing I cannot stand. I cannot stand you can call it crony capitalism. I don't know what you want to call it, but it is crazy. So you guys sold a 70-year contract for a little over $1 billion, and they collected it back in less than 5 years. Good Lord! Nah, I need to start buying them. I need to start buying some parking meter rights. Jesus Christ!
Absolutely fleeced. Those officials completely underestimated the business that they were sitting on. So how did blank asphalt and coin-operated meters become one of the most lucrative investments in modern American history? The answer starts in Nashville, Tennessee in 1952, with an office worker who just wanted to make some extra money on the side. Monroe Carroll Sr. was an office worker for the Nashville, Chattanooga, and St. Louis Railway when he saw an opportunity in the 1950s. That boring office job gave him something valuable: access. The railroad owned land all over the country, properties in downtown areas that weren't being fully utilized, surplus land that they just weren't doing anything with. Carroll had a simple thought: what if I lease some of that land and charge people to park on it? In the early 1950s, he leased a piece of railroad property in downtown Nashville and operated it as a parking lot. Business was good enough that he brought in Roy Dennis, another railroad employee with the same access to the same surplus land. Together, they leased more railroad properties, large parking lots in St. Louis, Atlanta, and Nashville. They named their little side venture Central Parking. Now, Carroll didn't know it at the time, but his timing was about to become perfect because the US government was about to hand him and every other parking lot operator in America an incredible gift. In 1956, President Eisenhower's Federal Highway Act unleashed what became known as a freeway building frenzy that fundamentally restructured how Americans lived and worked. Car ownership exploded. Highways connected every major city, suburbanization took off, and cities had no idea what to do with all of these.
Oh yeah, that definitely was perfect timing because before then, people really didn't have cars like that. But after that, everyone and their grandmother started buying cars.
Cities started writing parking minimums. 2 parking spaces required per apartment, 1 space per 200 square feet of retail, 4 spaces per 1,000 square feet of restaurant space. They literally made it illegal to build anything without providing massive amounts of parking. America would eventually build about 2 billion parking spots, 7 for every car on the road. Overnight, parking went from nice to have to legally required. Think about what this meant for someone like Carol. He stumbled into a side business that the government had just made mandatory. Every new building needed parking. Demand was guaranteed by law. By 1967, the business had grown enough that Carol's son, Monroe Jr., left his job as an electrical engineer at the Duck River Electric Cooperative to join Central Parking full-time. But here's the thing that matters most. Carol didn't have some unique insight about parking patterns or urban planning. He was just a railroad guy who looked at the surplus land his employer owned and thought, I could charge people money to use this. That's it. That's the whole insight. Access to an underutilized asset, plus a willingness to monetize.
Right. Another thing is that actually my friend who started his valet business, I think from what I remember, he started because I want to say he started just randomly, either by renting out his parking space, and this was in like 2009, by the way. I think he ran out his parking space to somebody at the club, and I think he might have charged him like $40 or something like that. It was definitely enough to really spark his interest and everything. And I just remember, because I remember he had asked me and my best friend at the time, he had asked us for a couple $100 to kind of help him, because he wanted to buy, or he wanted to buy or lease out. I'm not exactly 100% sure what he wanted to do and everything, like, because it was like, hey, I was so busy because I was a club promoter at the time and just kind of working in starting in finance as well. So I wasn't really focused on that, but hey, he was a good friend of mine. Hey, I just let him borrow, like a couple $100 and everything. And he said, of course, he'll pay us back once he get this contract worked out. And I mean, honestly, he paid us back. He borrowed some money again, and he paid us back, and it just seems like a pretty interesting thing. I was, just caught up in what I was doing. So if I would have thought about it, man, I should have. Gosh, I should have been like, nah, give me some equity.
And that exact same opportunity was sitting in front of hundreds of other operators all across America. They just needed to look at the land nobody else wanted and ask, can I charge for this? That's why parking businesses quietly grew through the 60s and 70s and then exploded into empires by the 1980s. Standard parking in Chicago, lazy parking in the Northeast, Ace parking in San Diego, and Central parking in Nashville. Most Americans had never heard of any of them. But Wall Street was starting to pay attention because parking lots had economics that most real estate investors were completely missing. Here's what most investors missed. They saw parking lots as unglamorous, overlooked real estate. Think about it from their perspective. You're competing with free street parking. Your product is literally just empty space. Real estate developers looked at parking lots the way that you might look at a lemonade stand. Cute, maybe profitable for a kid, but not serious money. They completely misunderstood the economics. Here's what those early parking operators discovered. A surface parking lot requires almost zero maintenance. No roof that needs replacing. No HVAC systems breaking down. No tenants calling about plumbing issues. You paint lines on asphalt once every few years. That's basically it. The operating margins were exceptional. Industry data shows net operating income margins of 60 to 70% on well-run facilities. Compare that to apartment buildings at 30 to 40% or restaurants at 10 to 15%. But here's where it gets interesting. You could raise prices constantly because parking operates as a captive market with limited supply. If you work downtown and there are only 3 garages near your office, you have to use one of them. You can't exactly work from your car. So operators, like Central Parking, would acquire a garage near major office buildings and gradually raise rates. $10 becomes $12, becomes $15, becomes $20. What are people going to do? Not go to work? By 1992, Central Parking was operating 225,000 spaces globally, running garages at London's Heathrow Airport and Malaysia's Petronas Towers.
Speaking of Heathrow, so I had a client the end of last year. I think it was like it was like end of last year because it was right before my birthday, everything, and he ended up winning a contract with Heathrow down in Atlanta, and he was doing like airport parking and everything. Now that business was projected to do like $60,000, $65,000 a month in revenue, right? And then the cost of operating is just so low. So I mean, I might definitely have to check back in with him, see that how's the business going and everything. But no, it's a pretty simple, straightforward business, everything. And then yes, you can buy the rights. I mean, and again, we have to think about it, especially when you're looking at opportunities. You have to think about opportunities like would I pay for something like this? So many people pay for the convenience of like parking their car, right? Because you don't really think about it because you're used to it, right? But like, I know I've paid for to park at someone's parking spot when I was like down at a game. Everything. Now, it's like, it probably cost me a little bit more. Yeah, of course. But could I have driven all the way around, went to the parking lot, hopefully found parking in the parking lot, and then got to fight to get out? Of course I could have. And I probably would only pay $20. But I don't mind paying $40. That means I can go from the game strictly to my car, and I'm on the street, and I'm like, I've cut out an hour, commute, an hour of just like headache and going back and forth and things like that. So I mean, that's very important when you're thinking about something that is very simple as like parking, or figuring out what it is that you have access to that you can monetize.
Monroe Carroll Jr.'s pre-tax income grew from $270,000 in 1980 to $3.6 million by 1991, according to company records. By 1996, the company posted revenues of $143 million the year after they went public. Most Tennesseans had never heard of them, or any other parking lot operator for that matter. But Wall Street was already paying attention, because parking lots had one more advantage that nobody was talking about. Here's what made parking lots brilliant from an investment standpoint. They were making money today while waiting to make even more money tomorrow. Let me explain how this worked. Say you buy a surface lot in downtown Nashville for $2 million in 1985. You charge for parking and net about $200,000 a year after expenses. That's a solid 10% annual return. But that lot is sitting on land that's getting more and more valuable every single year. Eventually, someone's going to want to build a high-rise on it. And when they do, that $2 million lot might sell for $10, $20, or even $50 million, depending on the city. So parking lots became this perfect asset class. You're collecting...
That's another thing. So this one smaller bank that I work with in my city, they had a parking lot for one of their locations. And then they end up selling it. And I think they actually just recently sold their other parking lot near their headquarters, everything. But either way, they end up selling that particular parking lot. Now, I think it was like maybe 100 feet by 50 feet, so 100 feet deep, when you pull into the parking lot, by like 50 feet across, maybe 60 and everything, but it definitely was 100 feet deep. And they sold it for... I know it was more than 15 million, but I don't think it was more than 20. I don't think it was more than 20 million. Now, I was telling them that they should probably just, develop it on their own, or at least do the financing for it, everything. They didn't end up doing it, but I mean, that's whatever on that part. But yes, I mean, parking lots, because my friend who started his valet business, he started off by renting their parking lot for the club at night on Thursday, Friday, Saturday, and Sundays. So I mean, the land value, especially if a city's really growing, oh my God, it will come back. Especially if it's like it's only a lot and everything. Now, if it's you buying a garage and stuff like that, I mean, those have limited economic upsides to them. But if you like are buying a lot where it's land, even if you build something. Even if you build like a 2-story or a 3-story, it doesn't matter, because you can always knock it down and build up. You can always knock it down and build a high rise, whether it's commercial, whether it's residential, mixed use, and things like that, depending on the area and the city.
Cash every day from parking fees while you're sitting on appreciating real estate and waiting for the highest offer. Wall Street loved this, private equity loved this. By the 2000s, major deals started happening. A private equity firm took Central Parking private in 2007. Investment funds started buying garages across the country. One industry report described it perfectly. Parking facilities offer stable, recurring, defensive cash flows linked to inflation through price increases. Translation, it's a cash machine that gets more valuable in good times and in bad times. But around 2018, some investors started asking a different question. What if we applied this same model to something other than cars? Look around any major city today and you'll see them. Fenced lots filled with shipping containers, Truck yards packed with semi-trailers, construction, and equipment yards. They look like parking lots because that's exactly what they are. Welcome to industrial.
Yep, and the guy and my client from last year, he started off because he was actually funny enough. He was actually selling his commercial lot. So he had 2 commercial lots. He was selling one of them. He's selling for like $400,000. It generated like 100, like probably passively like $120,000. So that's originally I was reaching out to that to acquire that one, but then we ended up talking, and then ended up figuring out that he actually didn't really need to sell that. He just needed to raise a little bit of money for his Heathrow airport parking.
Outdoor storage, or as the industry calls it, IOS. And it's become a $200 billion asset class that most people have never heard of. Here's what happened. Around 2018, investors noticed 2 massive trends colliding. First, e-commerce was exploding. Online shopping surged to 16% of all retail sales, a 33% jump from pre-pandemic levels. All those Amazon packages need warehouses, but more importantly, they need places to park delivery trucks. Amazon, FedEx, UPS, they all needed staging areas for their fleets, places to park hundreds of vans overnight, places to swap trailers around. Second, the US government passed a $1.2 trillion infrastructure bill. Suddenly, construction companies had more work than they could handle. But where do you store excavators between jobs? Where do you keep pallets of pipes and materials? You need outdoor storage lots. So demand for these industrial parking lots went through the roof. But just like with car parking in the 1950s, cities didn't want them. They didn't want open-air truck yards in their neighborhoods. Zoning made it nearly impossible to build new ones. Supply was completely restricted while demand was exploding. The result? Vacancy rates dropped below 3% by 2022. Essentially, zero availability. Rents jumped 30% from late 2019 to mid-2023, according to industry data. In the most coveted locations, rents are up 123% since 2020. And the economics that made car parking so profitable, they also applied here. Low operating costs. It's just land and a fence. Minimal maintenance, no buildings to fix, triple net leases. Tenants pay all the expenses. Captive customers. Logistics companies need these yards. Industry data shows iOS properties trading at cap rates of 6 to 8%, a meaningful yield premium over traditional warehouses, which were trading closer to 4 or 5%. So institutional money flooded in. JP Morgan committed $1.5 billion through a joint venture. TPG and Angelo Gordon announced over $1 billion in commitments. Even Middle Eastern sovereign wealth funds started buying US truck yards. The parking lot business had evolved. It wasn't just about cars anymore. It was about applying the same fundamental insight. Find empty land, charge people to park their stuff there, collect cash while the land appreciates. But this raises an obvious question. Is the parking lot gold rush over? What happens when ride sharing replaces car ownership? When electric vehicles change everything? Or when cities eliminate parking requirements? Here's what everyone worried about in 2015. Uber and Lyft are going to kill parking lots. And they were partially right. One parking operator in San Diego reported significant drops. Hotel parking down 5 to 10%. Restaurant valet down 25%. Nightclub valet down 50%. People were taking Ubers instead of parking. Cities started eliminating parking minimums. San Jose, California, a city of 1 million people, completely abolished parking requirements in 2022. California soon after passed a statewide law banning such requirements near transit. The narrative was clear. Parking lots were dying. But the best operators saw something different. They weren't thinking about the past of parking lots. They were thinking about what parking lots could become. Look at what's happening now. First, EV charging hubs. Right. Every parking lot in America could become an electric vehicle charging station. Fleet operators need places to charge hundreds of delivery vans overnight. That requires parking lots with massive electrical capacity. Some operators are installing solar canopies that both provide shade and generate electricity, creating 2 revenue streams from the same space. Second, multi-use optimization. Parking lots that serve office workers by day now host farmers markets on weekends. Some lease space to food trucks at night. Others are adding last-mile distribution lockers for package pickup. One company, Reef Technology, backed by SoftBank, went on a spree, leasing urban parking lots and garages to host ghost kitchens and micro-fulfillment centers. The lot itself becomes a platform for multiple revenue streams. Third, and here's the
now I have seen a parking lot because one of my business partners was looking at buying a parking lot earlier this year, and it was not a parking lot. It used to be a parking lot, but now they've turned it into a farmer's market. So it's a farmer's market 3 days out of the week, I believe, and everything, and it generates just as much money as it did as for the parking lot, because they have like I think 2 stands themselves where they like sell like I guess cooked food and stuff like that. I can't really remember what it was and everything, but the person ended up unfortunately the person ended up passing away and everything. So now their families kind of taking over that. So we're still looking into it, but it's like it's a hard pressed at the moment.
Irony, as cities eliminate parking minimums and stop building new parking, the existing parking lots become infinitely more valuable. It's simple supply and demand. If a city stops adding parking but keeps adding people and businesses, the parking that remains can charge whatever it wants. The investors who bought in early, like that Chicago parking meter deal, they're not worried about ride sharing or electric vehicles because the fundamental economics haven't changed. People and businesses still need to park things, whether that's cars, trucks, equipment, or shipping containers. And land in the right location with the right flexibility will always command a premium. But here's the critical insight. The reason parking lots became billion-dollar businesses was never about the parking. It was about understanding a pattern that most investors miss. The most boring businesses, serving the most basic needs with the least competition, often make the most money. Monroe Carroll in the early 1950s didn't invent anything. He didn't disrupt anything. He just had access to surplus railroad land, and he was willing to charge people to use it. That's it. While everyone else chased prestigious real estate, office towers, shopping malls, luxury apartments, he monetized asphalt and painted lines on it. While Wall Street chased tech stocks and hedge funds, a few investors bought parking meters and truck yards. The unsexy, overlooked corners of the economy, that's where they built their fortunes. Because wealth doesn't hide in the hottest places. It doesn't hide in whatever CNBC is talking about this week. It hides in the boring, forgettable businesses that solve simple problems and face almost no competition. Parking lots, storage yards, laundromats, self-storage facilities, cell tower sites. These aren't get-rich-quick businesses. They're get-rich-slowly by solving an obvious problem that everyone takes for granted businesses. So next time you're in a parking lot, look around because someone owns it, and chances are they're making a hell of a lot more money than you think. If this kind of thinking clicks with you, if you're starting to see how something as boring as a parking lot can turn into a cash flow machine, that's exactly what I teach inside the CRE Accelerator.
Nah, awesome. Well, listen, yeah, I mean, great video. If you guys can, definitely make sure you go and check out Tyler. I want to say it's Cauble or Cauble. I'm not sure. I'm so sorry, to get his name wrong and everything. But no, definitely check out. I've watched 1 or 2 of his videos before and everything. I think he's just mainly focused on commercial real estate. But anyway, well, listen, my thoughts on stuff like this is that, of course, the boring businesses always are the most profitable businesses. Like I met a guy many years ago where his family created elevator buttons, and then his other guy's family that I met, they made inserts and everything. They had a patent on the inserts in like jewelry boxes and whatnot. So very interesting. The riches, when they say the riches are in the niches, they are not lying. So, whatever you can do, if you're out there and you see something, I mean, we live in a capitalistic country. We live in a country where, you have to get in where you fit in, right? But there's so many different things that you can do. This is a truly creative nation, and you got to take advantage of that. But anyway, if you like videos like this, and if you like this video, please remember to like, subscribe, comment, do whatever. It all helps. And with all that being said, I'll see you on the next one. Thank you so much.